Welcome along to the deep dive. We've been wading through quite a pile of source material, articles, notes, bits of research, all focusing in on one very specific moment, October 3rd, 2024.
Mhm.
And our goal here really is to unpack what happened, to understand how those escalating tensions in West Asia on that exact day caused, well, pretty significant tremors across global markets.
Yeah, ripples that spread far and wide.
Exactly. Hitting oil prices, currencies, stock markets, you name it.
It's such a stark reminder, isn't it?
Yeah.
How interconnected everything is. Something happening way over there can, affect your daily life pretty quickly.
Absolutely. And one source, it had this great analogy, actually. It described the global oil market that day like a pot of spicy curry suddenly boiling over.
Huh. That's quite an image.
Yeah, just spilling everywhere, everyone's scrambling, feeling the heat.
It really captures that sudden chaos, that spillover effect.
So let's dig into it. West Asia, October 3rd, 2024. What was the core issue causing all this heat?
Okay, so the main thing, the flashpoint, was this really sharp spike in tensions between Israel and Iran. Things had gotten pretty critical.
Critical how?
Well, the fear gripping the markets wasn't just, general things are tense. It was very specific. The potential for retaliatory strikes
Strikes against what?
against Iran's oil facilities. That was the big worry.
Ah, right. And why is that specific threat such a big deal for global markets?
Well, because West Asia fundamentally is the world's oil pump.
Right.
And you got heavyweights like Iran, Saudi Arabia. They're huge players in global supply.
So any disruption there?
Any threat of disruption, especially to actual production or export facilities, it's massive. It's like yanking the power cord on a huge chunk of the world's energy supply.
Okay, like unplugging the Wi-Fi during a global Netflix binge, as one source put it.
Exactly. Maybe not quite that catastrophic, but for energy markets,
Yeah,
close. It sparks immediate panic about shortages, sending prices upwards.
got it. And the most obvious place that fear showed up was in crude oil prices, right? What did the numbers show for Brent crude on October 3rd?
Yeah, Brent crude definitely reflected that anxiety. We saw a clear upward move. In futures trading, that's basically bets on future prices, it climbed 1.66%,
1.66%.
okay, which pushed it to $75.13 per barrel by the end of the day. And remember, a barrel is about 159 liters, so it's a significant volume.
$75.13. What does that number actually mean for someone, listening to this? For you and me?
Well, it's not just a number on a screen.
Mm,
A jump like that signals higher fuel prices are probably coming down the pipeline.
right, at the pump.
At the pump, yeah. But also it means higher shipping costs for everything, which eventually, can mean higher prices for groceries, other goods.
And the sources really hammered home how vulnerable some countries are, like India particularly.
Oh, massively. India imports something like, 83% of its crude oil needs?
83%, that's huge.
It really is. So its economy is incredibly sensitive to these kinds of price swings. One source used the analogy of India being a thirsty camel and West Asia the main oasis.
So if the oasis has trouble,
India's economic journey gets a whole lot tougher. It really strains the system.
it makes you think, doesn't it? That source mentioning maybe needing bicycles or cooking over campfires if prices kept going up. A bit tongue-in-cheek, maybe?
Maybe a bit dramatic, sure, but it underlines the real economic pain these price hikes can cause for a major importer.
Okay, so oil was boiling over. Where else did the heat spread on October 3rd? Let's talk currencies. The Indian rupee.
Yeah, the rupee definitely felt the heat, too. It weakened against the U.S. dollar. It closed down 14 pays at 83.96.
14 pays down.
Right. A pays is just a fraction of a rupee, but that was the drop for the day.
And looking at the day's trading, it didn't start that low, did it?
No, actually, it opened a bit stronger, around 83.91 on the interbank market. That's where banks trade currencies. But then, as the day wore on, as the West Asian news sunk in and other factors played out, it slipped, hit a low of 83.97 at one point, before settling just under that.
The sources had that image of the rupee tripping while the dollar flexed.
Huh. Yeah, that captures it well. The dollar was strong, and the rupee felt the pressure.
So what was driving that pressure? Just the West Asian news.
That was a big part of it, definitely the risk aversion it created, but it was also about the U.S. dollar itself being strong globally.
Right, the dollar index.
Exactly. The dollar index, which tracks the dollar against other major currencies, it rose 0.23% that day to 101.91.
And when the dollar index goes up?
Generally, yeah, other currencies like the rupee tend to weaken. It costs more rupees to buy $1, essentially.
Okay. And Forex traders, the people watching this minute by minute, what was their take?
Well, Analysts like Anuj Chaudhary, mentioned in the material, were expecting this slight negative bias for the rupee.
Meaning they expected it to weaken.
Yeah, exactly. Because investors were shying away from risk, that's the risk-aversion bit, and the dollar was just robust. The sources described the rupee as hiding under the bed, hoping the geopolitical monsters would go away.
Makes sense. It almost makes that sarcastic comment about paying for chai in dollars feel, well, a bit closer to home when the currency moves like that.
It highlights how much currency stability matters, definitely.
Okay, so rising oil, falling rupee, a double whammy. How did India's stock market handle that?
Not well. Not well at all. Stock market took a real dive.
How bad was it?
Pretty bad. The BSE Sensex, one of the main indices, it crashed 1,769 points. That's a drop of 2.9%, settling below 82,500.
Wow, over 2%. And the Nifty?
Similar story. The Nifty tanked 546 points, which was 2.12%, closing around 25,250.
Ouch. That really is like watching your favorite cricket team get absolutely thrashed, like the sources said.
It felt like that for investors, I'm sure. And the reason? It was the same story. Those West Asia tensions spooking everyone.
Driving up oil, weakening the rupee.
Exactly. When markets smell that kind of geopolitical trouble and economic uncertainty, the instinct is to sell, to run for cover.
And we saw foreign institutional investors, the FIIs, doing just that.
Yes. The data showed FIIs were net sellers that day. They're big overseas players, so when they sell in large volumes, it really adds downward momentum.
Kind of like the market shouting, "Nope, I'm out," and sprinting for the door.
That's a good way to put it. It definitely felt like a rush for the exits.
So for you listening, if you had money in Indian stocks or mutual funds back then, October 3rd probably wasn't a great day for your portfolio.
No. If it looked like it had gone through a blender, as one source vividly put it, you could trace it back to that West Asia drama and the strong dollar.
It really shows how these big global events hit home, doesn't it? Right in your savings.
Absolutely.
Which brings us back to India's sensitivity. Why is this particular mix, high oil, weak rupee, such a problem for the Indian economy? What makes it wobble on that tightrope?
Yeah, the tightrope analogy is apt. India's position makes it particularly vulnerable. Those two factors, high oil and a weak rupee, are like sudden gusts of wind threatening its balance.
Okay, let's break down why. The sources highlighted a few key vulnerabilities. First, obviously, the oil imports.
Right, we touched on this. That 83% import dependency is the big one. When global prices spike, India's import bill just balloons.
Which strains the trade balance.
Hugely. You're spending way more foreign currency on oil imports than planned. It's like your personal budget suddenly getting wrecked because your commute cost doubled overnight.
And that feeds into inflation, doesn't it?
Directly. Costlier crude means higher fuel prices. And since transport costs are baked into almost everything,
food, goods, services,
it pushes up prices across the board.
Yeah.
Broader inflation. And India was already grappling with inflation above the central bank's comfort level. So sustained high oil makes even essentials feel expensive.
Then there's the government's budget, the fiscal deficit.
Yes, that gets hit too. A bigger oil import bill messes with the government's math. The gap between spending and income, the fiscal deficit, can widen.
Which forces tough choices.
Exactly. Maybe cut spending elsewhere, maybe reduce subsidies on things like LPG or petrol, maybe even raise taxes. None of those are popular options.
Oh, kidding. And the current account deficit, the CAD. There's a specific number mentioned there.
Yeah, Tamer Beg from DBS Bank Group was quoted suggesting a 10% rise in crude could widen India's CAD by about 0.4 to 0.5% of GDP.
And the CAD is basically...
It's essentially whether the country is spending more internationally than it's earning. A wider deficit means you're deeper in the red on that front, which isn't great long term, and adds more pressure on the rupee.
It really paints a picture of multiple pressure points. That Bollywood movie analogy from the sources seems quite fitting.
Yeah. Which one was that?
The RBI as the hero trying to save the day, but geopolitics as the villain constantly throwing curveballs. Cue dramatic music.
Okay. Yeah, I can see that.
Yeah.
A high-stakes economic drama playing out.
And it's important to remember this isn't just an India story, right? This West Asia situation is global.
Absolutely. It's a global soap opera, really, involving all the major oil producers. Any instability there has worldwide implications because so many economies depend on that steady flow.
And we've seen this kind of thing before. The sources brought up the 2019 attacks on Saudi Aramco.
That's a key reference point. That attack knocked out about 5% of global crude production temporarily.
And the market reaction then?
Significant. Brent crude jumped almost 20%, hitting nearly $72 a barrel. And the rupee fell sharply against the dollar then, too, about 68 paise.
So definite echoes. History kind of repeating, maybe with different players or higher stakes in 2024.
That's the feeling, yeah. Similar dynamics, but perhaps intensified by the specific Israel-Iran tensions this time. And there's that other specific fear the sources mentioned.
The Strait of Hormuz.
Exactly. That's the big one.
Why is that particular strait so critical?
It's just this incredibly narrow channel, a bottleneck really, that a huge chunk of the world's oil and, crucially, liquefied natural gas, LNG, has to pass through.
Like a highway choke point.
A massive one.
Yeah.
If tensions escalated to the point where passage through Hormuz was blocked or seriously threatened, a nightmare scenario analysts warned about, it would be catastrophic for supply chains.
And for India.
For India, relying heavily on imports through that route. It would be like the main road delivering essential energy supplies being completely shut down. Prices for oil and LNG could absolutely skyrocket.
Suddenly, that slightly absurd idea about investing in camel caravans to bypass the strait doesn't seem quite so funny.
Well, it highlights the severity of that particular choke point, that's for sure.
Okay, so amidst all this chaos, you have the Reserve Bank of India, the RBI, trying to manage the situation, the economic firefighter, so to speak.
That's a good way to put it.
Yeah.
And they have a really tough job. They're trying to keep inflation under control, stabilize the rupee, support growth,
Yeah.
all while this geopolitical storm is raging.
It's a juggling act.
A very difficult one. And on October 3rd itself, there was talk, strong suspicion really, that the RBI stepped into the currency market.
To support the rupee.
Yes, to prevent it from falling even further. They likely sold U.S. dollars from their reserves to buy rupees. It's a standard tactic, kind of like the central bank trying to gently guide the market back from the edge of the cliff.
The parent calming the tantrum analogy from the source.
Exactly. Trying to restore some order when the market gets panicked.
And this was all happening with an RBI policy meeting looming, wasn't it? December 6th.
Right. And given the high inflation, fueled partly by these energy price worries, the general expectation was that the RBI would likely keep interest rates on hold. Status quo.
Why not hike rates to fight inflation?
Because hiking rates could also slow down economic growth, which is the other side of their mandate. It's a balancing act.
And some analysts thought a steady hand might actually help.
Yeah, people like Amit Pabari suggested a balanced, predictable stance could actually attract foreign investment back into India.
Which would help the rupee.
Potentially, yes. More foreign investment means more demand for rupees. But, the sources also made it clear the RBI's power is limited when you're up against massive global forces like soaring crude and a really strong dollar.
Trying to fix a leaky boat in a hurricane?
Something like that, yeah. They have tools, but they can't control the weather.
Let's bring in some of those other analyst voices, the economic weather forecasters. What specific things were they saying on October 3rd?
Well, they were cautious, as you'd expect. Anuj Chaudhary from Sharkan predicted the rupee would probably stay in a range, 83.75 to 84.20, mostly because of that risk aversion and strong dollar.
Okay.
And Jatin Trivedi from LKP Securities, he pointed to the dollar index being above 106 as a key reason for the rupee's weakness.
So connecting that back to you, the listener, what's the practical takeaway from these analyst views?
It basically means keep an eye on prices, especially fuel. You might need to budget a bit tighter, brace for higher costs generally because of these global shifts.
Maybe rethink that long road trip like the source suggested.
Yeah, stick local unless you want your wallet to weep. It's about being aware of how these big numbers translate into real-world costs.
Definitely practical, if a bit sobering. And as we said, India's been through these oil shocks before. Those 2019 parallels are strong.
Very strong. You saw the Sensex dip then, too. And economists like N.R. Banimurthy were warning even back then about the economic dangers if high oil prices stuck around.
Same concerns, different year.
Pretty much. And you likely had the government trying to reassure everyone in 2024, just like they did in 2019 when the petroleum minister relied on Saudi promises.
But soothing words don't always work.
Not when the market's acting like that cat on a hot tin roof, as the source put it. Investor sentiment can be hard to calm once fear takes hold.
So looking ahead from that October snapshot, what did the path forward look like according to the sources?
It really hinged on whether those West Asia tensions cooled down and got worse. The big fear, highlighted by firms like Motilal Oswal, remained that Strait of Hormuz scenario.
A blockade or major disruption there.
Yes. If that happened, the consensus was grim. Soaring crude and LNG prices, hitting India's economy incredibly hard.
And for the average person, that means.
Much tighter budgets, significantly higher prices for essentials, maybe shelving plans for big purchases or travel. A real squeeze.
But there was a bit of a cushion mentioned, India's reserves.
Yes, that's the buffer. India had substantial foreign exchange reserves, around $638 billion as of early 2025.
Which the RBI can use.
Exactly. They can use those reserves to intervene, to sell dollars, and support the rupee, cushioning the fall. It's a vital tool, though obviously not limitless.
Some shock absorbers, at least, which maybe brings us back to those humorous suggestions about backyard oil wells or solar scooters.
Well, they do point towards the longer-term solution, right?
Yeah.
Reducing that fundamental reliance on imported fossil fuels from volatile regions.
Diversification, energy independence.
Exactly.
So, stepping back one last time, what's the big picture lesson from this deep dive into October 3rd, 2024?
I think the overwhelming takeaway is just how incredibly interconnected everything is. A flare-up in West Asia doesn't stay in West Asia.
Right.
It ripples outwards instantly.
Yeah.
It affects the price you pay at the pump, the cost of your groceries, the value of your pension fund or investments. That source analogy of a domino in Tehran knocking over a chai cup in Mumbai really nails it.
And for a country like India, it highlights a massive challenge.
A huge one. The need to diversify energy sources, to reduce reliance on oil from potentially unstable regions. It makes things like solar, wind, EVs. They're not just nice-to-haves, they're becoming economic necessities.
Lifelines, almost.
You could say that. And things like government subsidies for EVs become part of that strategic shift.
And it wasn't just geopolitics influencing things, right? Other economic data mattered too.
Absolutely. The sources mentioned keeping an eye on things like U.S. jobs reports, the non-farm payrolls. Strong U.S. data could boost the dollar even more, adding pressure. It's all connected.
Complex web. So if tensions eased, maybe some relief.
That's always the hope. Markets might bounce back, the rupee could recover somewhat, but the underlying fragility, the potential for the next crisis, that remains.
And that concludes our deep dive, a look back at October 3rd, 2024, and the economic waves sent out from West Asia, boiling crude, a pressured rupee, jittery stock markets.
Yeah, quite a snapshot. And the takeaway for you, listening. These distant events can and do hit your wallet. So plan smart, save smart, maybe keep that sense of humor about the sheer complexity of it all.
Right. Makes you look at those historical oil shocks, maybe even bicycles, a little differently. Staying informed isn't just academic, it's about understanding the forces shaping your world.
Definitely. That price on the petrol pump sign is telling a huge story about geopolitics, supply, demand, things happening thousands of miles away.
Which leaves us with this final thought, pulled from the material. Just think about how profoundly events in places you've maybe never even thought about, on dates that might fade from memory, can directly shape the cost of your daily commute, the food on your table. It's really a vivid illustration of just how tangled up our global economy truly is.